So over the past 5 years since I've started my own business abroad, I've become of course very interested in personal finance. So today, instead of pretending to have all the answers to your finance related questions, I thought I would share with you a few important lessons that I've learned along the way. For those of you who don't know who I am, my name is Gabriel. I'm a business owner currently based in Tokyo, Japan. I came to this country with $0 with the objective of creating a business that in its first full year ended up making over $100. In its first full year, ended up making over $100,000 in income. So with that out of the way, here are 5 habits that are stopping you from building wealth and making a significant financial change in your life. So the first bad habit that many of us get into is actually at the end of the month when you first get your salary or when you get paid. You cover all the expenses that need to be covered, you pay for whatever it is that needs to be paid, and then save or pay yourself with whatever is left. But let me tell you why, while this might sound safe, it's a strategy that could cost you the future of your business. So when I started my first business about 5 years ago, I knew that, of course, in order to build some kind of wealth, I needed to set some money aside and to put some money into savings and investing accounts. So I started getting into the habit of covering all of our business expenses, and then with whatever was left, I would put it into some general index funds like the S&P 500, for example. And essentially the plan was to just leave that money there, not touch it for 30 or so years, and then hopefully when it was time for me to retire, I would have seen some substantial return to that investment. But I did not know that this strategy was actually costing me the future of my business. On the surface, it absolutely looked the right way, saving some money, setting some money aside for the future, and hopefully see some good returns along the way. But the problem is that I was not doing it in the way that best reflected my business. On the one hand, of course, during those first years of business creation, we were basically covering all of our expenses with all of the money that was coming in. And of course, when you declare them as expenses, that can lessen the burden of the taxes that you have to pay. However, while it's absolutely right that people who make more money pay more taxes, there is a very good reason for that. There are, of course, many ways that can help you pay less taxes in a legal manner if you, for example, get a 401k through your employer if you happen to be in the States. But if you are, or if you're trying to be a business of good standing, you need to be able to prove to your government that your business can withstand the weight of its financial responsibilities. And a very good way of doing that is by actually paying your employees properly. And guess what? You are actually one of the employees of your business. So while it doesn't have to be a lot of money, you definitely do have to get into the habit of paying yourself first and then setting it aside, putting it perhaps into a savings account or into your investments if that's what you plan to do with it. I mean, think about it. If you actually had employees in your business, you cannot tell them, all right, first let me cover all of my expenses and then I'll pay you with whatever I have left. I'm sure you see why that's not a very good idea. So if you're planning on asking for a loan or perhaps expanding your business, you should also not let the government or the banks see you making that kind of stupid choice. So pay yourself first. Besides, that's actually going to skyrocket your savings because instead of just putting a few dollars here and there at the end of every month, you're actually setting aside a predetermined amount of money that's accumulating and generating growth for your future. Okay, so our next bad habit is actually paying yourself less. So in reality, we all have things that we have to spend money on, like your business expenses, your debt and so on, and things that we like to spend money on. It could be holidays, it could be presents for your friends or family, it could be going out on a date. And generally, we make those spending decisions based on how much money we have. The problem comes when those purchases match or even surpass the amount of money that actually comes in every month. You see, you get your salary and after you've paid for the rent and groceries and so on, you see that you still have a bit of money left in your account. So you decide to go on Amazon and buy some new shoes, maybe buy some new earphones for your computer. But in reality, you didn't have that money to spend to begin with. What you should do is actually follow the 50-30-20 rule. Now that's a rule that basically states that you spend 50% of your money on the things that you have to pay for, like your rent, your groceries, your business expenses and so on. 30% on the things you want, like your holidays and presents for your family or for your hot date, and then 20% into your savings. Now, the way you distribute those percentages is entirely up to you, but you have to be able to keep good track of how you're spending your money. And besides, when you don't do this, you're basically following the 50-50 rule, which is basically covering your expenses and then spending whatever is left on the things that you want. And you're not leaving anything for your future. Now, as I said before, the percentages are entirely up to you, but just keep in mind that in 2023, the average savings rate in the US was a measly 3.5% of salary. So as I said in our bad habit number 1, what you need to do at the beginning of every month is pay yourself and then set a predetermined amount of money from that income into your savings account. So the moment you receive it, you send it immediately to your savings or investing account and basically pretend that it never existed. You set that money aside and forget about it. And then of course you let it grow on its own for the next 30 or so years. And like this, you're having money that is actually working for you and safeguarding your future. And whatever's left of your salary after you've covered the other expenses is what then you can use to buy whatever you want. Your Netflix subscriptions, your shoes and your earphones. And our next bad habit is that you are not tracking your finances. At least you're not tracking them well enough. Now, I know it sounds very obvious, but people who know how much money they have, what kind of assets they have, how much debt they have, and who also understand how they're spending their money are much more likely to build wealth. Now, unfortunately, because many of us may have been raised in an environment where it's generally frowned upon to talk openly about money, some of us don't like to talk or even think about it. But you have to keep in mind that it's exactly that that's going to make it much more likely for you to lose control of your finances. But in short, in order to be in control of your finances, you have to be aware of 3 things: your assets and liabilities, your income, and your expenses. So to fundamentally change how you approach money and to finally start to realistically build wealth, you need to take the following steps. First, you have to figure out what your actual net worth is. You're going to take all of your assets, how much money you have in your bank accounts, cars, house, whatever it is, and you're going to subtract your liabilities, all the things that make you lose money. These are things like your student loans or debt in general. This is going to give you a rough idea of what your actual net worth is, and it's going to become your new baseline upon which you're going to start building your wealth. Now, the second step, which is a step that many people like to skip, is actually keeping track of your expenses. Now, generally, I like to divide my expenses in 2 categories: what I have to spend money on and what I like to spend money on. Now, of course, what I have to spend money on is my business expenses, the rent, the mortgage, and so on. And what I like to spend money on could be just presents for my family, a date night with my wife, and things of that kind. Now, our third step, and I think this is a very crucial one, is that you have to calculate your real hourly wage. How much money you're actually making every hour of the day. So first, you start by taking your actual income and subtracting all the additional expenses that allow you to do your job. That's things like commuting, buying clothes for work, and so on. Then on the other hand, you're actually going to work out how many hours a month you dedicate to your work and the things related to it. This includes your commute, your time to prepare for you to be able to do your work. Then you're going to subtract your actual income by the number of hours, and this is going to give you your actual hourly wage. This is how much money you make every hour. From now on, every time you have to make a purchasing decision, don't look at it as an amount of money, but actually as an amount of time that you have to give for free in exchange for this purchase. So let's say if you want to buy a new computer and you would normally tell yourself, well, it's only $1,000, so I'm sure I can buy it. Now you'll think, well, it actually takes me 80 hours of work to buy this computer. Am I willing to give away 80 hours of my work for free? And generally this is going to make you think a little bit harder before jumping at spending that money. Okay, so this next step is basically for when you've already started to get your finances in order and decide to begin investing. And obviously the first thing you have to have clear is that if you're not investing regularly, you will never build any kind of significant wealth. But there's another bad habit that people often have when they start investing, and that's actually trying to guess what the market is going to do. When you buy a stock or when you invest your money in a company, you're basically saying that you believe that the value of this company is going to go up and that you trust that you're going to end up making more money later. The problem is that there are so many factors that determine whether the value of a company is going to go up or down, whether it's oil, real estate, or maybe even a share of Apple. And I'm sure many of you have heard of that experiment that was done in Princeton University, where from 1963 to 2010, they replicated 100 monkeys throwing darts at the stock pages each year. And in over 98% of the cases, the monkeys actually beat the market value index, meaning that they were essentially able to make more money than the market analysts would have been able to make. So in short, if an expert is not able to accurately predict what the stock market is going to do, then I don't think it's very likely that someone who doesn't have much or any knowledge of the stock market at all would be able to do so. So there are two strategies that you can apply in order to basically navigate yourself healthily through your investments. And the first is, of course, diversifying your portfolio. Essentially, you're not going to put all your eggs in one basket. For example, if you put all your money into Tesla, that means you're absolutely certain that the value of Tesla is only going to go up and that you're going to end up making more money. Now, of course, you could be right, but if you're wrong, that could end up being very costly for you. And so that's where the magic of ETFs comes into play. It's basically a large group of companies presented as just one single asset. This gives you the benefit of being spread over multiple companies by just buying a single product. The second element is that you shouldn't, under any circumstances, try to time your investments. It's very unlikely that you're ever going to be able to determine where the bottom of the market is, and then when you put all your money in, and then from that point on, it's only going to go up. That's just not how the market works. Instead of putting all your money in at once and then hoping that maybe your hunch was right, you slowly invest over time. So like I said earlier, you set a predetermined amount that goes into your investing account, and then that's going to go into your stocks and ETFs and index funds. Of course, this means that at certain points the market will be lower or higher, but hopefully over the long term you'll be able to see some significant growth. Okay, and our next bad habit is that you're not actually learning enough about finance. We're fortunate enough that we live in a world where we have all the knowledge that we might need within our reach, so you have to take advantage of it. You should consume finance-related content, you should read books about finance, you should talk to people who are knowledgeable in the field. This is the only way to truly feel comfortable and to understand how to manage your finances. So now that you've finally understood what are the habits that are keeping you poor, you need to watch this video right here to learn the actual steps you need to take to finally start building your wealth. So don't miss out, and I'll see you next time.